We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. The Fed is expected to cut rates yet again, the biggest moves in any bull market, and this is not just for gold, but in general, when you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market. And these sharp corrections are designed to scare out the weaker players, people who may have just come into the market more recently and just kind of get rid of them, get rid of the dead weight, the excess baggage before we move up to new highs. Gold's bull market remains firmly intact despite the recent pullback, which many misinterpret as a sign of weakness. Sharp corrections like these are the market's way of shaking out short-term traders and testing conviction before resuming its higher path. Historically, every major bull run has been marked by sudden drops that catch investors off guard, moves designed to transfer wealth from weak hands to strong ones. Meanwhile, central banks continue to accumulate gold at record levels, while divesting from U.S. Treasuries as trust in the dollar's long-term stability erodes. That steady demand forms the bedrock of this ongoing monetary shift, even as mainstream analysts misread it as mere profit-taking. Peter Schiff, veteran economist and founder of Euro-Pacific Asset Management, explains that this correction is not an end, but a reset. With inflation still rising, rate cuts on the horizon, and gold holding a $4,000 floor, he warns that those waiting on the sidelines risk missing the next explosive leg higher. As he puts it, these dips are gifts, opportunities to accumulate before the next wave of institutional capital arrives. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video. To me, it does indicate that investors are finally getting interested in gold. Now, they're not interested enough, and there's not enough of them who have gotten interested. But now, after having no interest whatsoever, they're finally starting to recognize that they should buy gold. And I think that that is a good sign, because I don't think that the money that came into ETFs in the last few months is done. That now that gold has pulled back from 43 and changed back to 4,900, that whatever interest was prompted is now gone. No, I think that's the tip of the iceberg. We have a lot of money that's going to be following up. Now, yes, there may have been some short-term leverage speculators that got burned because they came in late and they got surprised by a big correction. That's possible. But all of this is normal in a bull market. And as I've been pointing out, the biggest moves in any bull market, and this is not just for gold, but in general, when you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market. And these sharp corrections are designed to scare out the weaker players, people who may have just come into the market more recently, and just kind of get rid of them, get rid of the dead weight, the excess baggage before we move up to new highs. But the media acts like, oh, this is the top, right? Get out. If this was the top, nobody would know. I mean, that's how tops are generally made, or bottoms. Like, you don't really realize that you're at the top until you're a long way down, right? The market, they don't ring a bell at the top or the bottom. And so you don't get this big drop that says, aha, the gold bull market is over. No, these big drops like that are a sign that the bull market is alive and well. It just has this correction. And of course, the market was getting overbought, of course, not overowned. Overbought is a technical term because very few investors own gold. Gold ownership among institutional investors and retail investors is historically low. That's why a lot more money is going to come in. But again, what's also very significant is that the central bank buying is not even close to ending. They are ongoing buyers. They are buying for a reason. They need to increase their gold reserves. They need to decrease their US dollar reserves. And so this is going to happen regardless of the price of gold. They are buying, and they're not buying their gold to turn around and sell it. They're buying their gold to hold it in reserve to provide backing for their own currency, backing that they can no longer really have with the US dollar or US Treasuries, given the likely decline in the value of the dollar and Treasuries. And so they are divesting. And so this is going to continue. But the investor interest, I think, is going to continue to pick up in gold and silver. So I don't think the highs that were established last week and earlier this week, those are not the highs. Those are just a temporary high. I would be surprised if we didn't take those highs out before the end of the year. We could easily move quite a bit higher than those highs. We're not getting a lot of economic news because of the government shutdown. We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. The Fed is expected to cut rates yet again, and that is despite the news that we got today. We finally got some government economic data. I guess they forced them to do this even though we're in the shutdown. They released earlier this morning the CPI numbers for September, and consumer prices rose 0.3 on the month, which was a bit below the consensus of 0.4. But the more significant number is that year-over-year CPI is up 3%. Now, that's 0.1% hotter than the prior month, slightly below the 3.1% that analysts had expected. But what's more significant is the sequential number going up. So, we were at 2.9. We didn't go down from 2.9, we went up to 3. Now, remember, the Fed claims that its target is 2. So, if your target is 2 and in the last month you moved up from 2.9 to 3, so you're 50% above,